Every morning, in bustling markets across Ghana, money changes hands. It's a daily rhythm of buying, selling, and saving that keeps the community connected. At the center of this local economy is Auntie Ama. She manages the neighborhood Susu, a community savings group. Every week, dozens of people hand her their extra cash, and she carefully records each contribution in a single, well-worn paper notebook. The system works beautifully, as long as everything goes right. But consider the risk. If Auntie Ama's notebook gets caught in a rainstorm, falls into the wrong hands, or is simply misplaced, the entire neighborhood's financial record vanishes. This is how traditional banking works too. We place all our money and all our trust into a central point, and if that central point fails, breaks, or makes a mistake, everyone connected to it suffers. Now, imagine if we could upgrade Auntie Ama's ledger. Imagine a magic notebook. The exact moment she writes down a payment, that page instantly duplicates itself, updating thousands of identical notebooks stored on the phones of everyone in the community. If someone tries to cheat the system by erasing a payment on their copy, the network compares it against all other notebooks. The community spots the difference and rejects the lie. This perfectly synchronized digital notebook actually exists. It is called a blockchain. Because the entire community is constantly double-checking the work, it's effectively impossible to change the past. Once a page is written, it becomes a permanent record that cannot be erased, edited, or hidden. By sharing the record with everyone, the blockchain completely removes the need for a central bank or a boss. You get the unbreakable security of a watchful community instead. This shared network is where cryptocurrency lives. Cryptocurrency is simply digital money secured by this decentralized system, managed by everyday people instead of a government printing press. The first and most famous of these digital currencies is Bitcoin. Over time, investors have given it a specific nickname, digital gold. Bitcoin earned this title through scarcity. The software running the network has a strict mathematical rule hard-coded into it. There will only ever be exactly 21 million Bitcoins created. The system enforces this limit through a process called a halving. Every 4 years, the reward given to the computer securing the network is cut in half. The flow of new Bitcoin continually slows down. Traditional paper money can be printed indefinitely, diluting its value over time. Bitcoin's predictable mathematical scarcity makes it a highly attractive long-term store of value for investors looking to protect their wealth. In 2015, a programmer named Vitalik Buterin realized the blockchain's potential. He launched Ethereum to expand the network's capabilities, allowing it to store digital code as well as simple transaction totals. Ethereum introduced an innovation called the smart contract. A smart contract is an agreement written entirely in computer code. When the conditions of the agreement are met, the code executes the transaction automatically. There is no lawyer to draft paperwork and no bank middleman taking a fee. Think back to Auntie Ama's Susu group. With a smart contract, the community's weekly savings could be collected by the code, and on the first day of the month, the exact payout would be sent directly to the right member. Nobody has to press a button. If Bitcoin is a secure vault for digital gold, Ethereum is a programmable world computer, automating trust and handling complex tasks across the internet. While the technology itself is incredibly secure, the market value of these assets is a different story. Because there is no central government or physical commodity setting the price, the value depends entirely on what people are willing to pay at that exact moment. This reliance on public opinion leads to extreme price swings. It is common for the market to drop by 50% or more, making cryptocurrency a high-risk asset for those looking for stability. To solve this problem for people who want to use crypto for daily spending, developers created stablecoins. Stablecoins bypass the roller coaster by pegging their value directly to a traditional asset. 1 unit of a stablecoin is designed to always equal exactly $1. This creates a safe harbor. You can send money instantly across international borders using the blockchain without worrying that your funds will lose their value overnight. Removing the bank comes with an ultimate trade-off. There is no customer service department. If you forget your password or send funds to the wrong address, no one can reverse the transaction. To be your own bank, you must be the only person who holds the private access codes to your funds. If you leave your money on a trading platform and that company goes bankrupt or gets hacked, you could lose everything. The safest approach is cold storage. This means taking your assets completely offline and securing them on a physical hardware wallet, a small device that keeps your access codes away from the internet. Before you buy anything, remember the 3 rules for beginners. Do your own research. Only invest what you can lose. Hold your assets long-term, rather than chasing quick riches. Cryptocurrency shifts how we control our own value. It removes the middlemen, but asks you to step up. Embracing this new frontier requires accepting total ownership and total responsibility for your financial future.